Welcome to today's lesson. Today, I'm going to take you through valuation of convertible debentures. So we have many types of debentures. If you are pursuing financial management and a CPA, you are supposed to know how to calculate the value of redeemable debentures, irredeemable debentures, and convertible debentures. So if you already know how to find the value of redeemable and irredeemable debentures, in this lesson, you're going to learn how to calculate the value of a convertible debenture. So before I show you how to find the value of a convertible debenture, let us start by having the basic understanding of what is a convertible debenture. So this is the meaning of a convertible debenture. These are debentures that can be converted into shares of the company after a specified period or under certain conditions. So convertible debentures can be converted after a specified period. If the period is 10 years, then after 10 years, you have the option to convert them into shares or to redeem them, to keep them as debentures and eventually redeem them. It can also be under a certain condition. The company can tell the investors if the share price reaches a certain level, then you can convert the debentures into shares. Or if the company's profit reaches a certain level, you can convert. Or if the company goes public through initial public offer, IPO, then you can convert. In short, debentures can be converted after the given period of time or when the condition that is set happens. So why do companies issue convertible debentures? These debentures have benefits to both the investor and the company. So let us look at 3 benefits of convertible debentures. The first one, investors are willing to accept a lower interest rate due to the conversion option. This means low borrowing cost for the company. Convertible debentures are more attractive than non-convertible debentures because it gives the investors the option to keep the debt or to convert the debt into shares. Therefore, because of having the 2 options, debentures become very attractive such that the investors can still buy them even at a low interest rate. The second benefit is that the company can avoid the burden of repaying the debentures at maturity if conversion takes place. So when the debentures mature and the investors decide to convert them into shares, it means the company will not have to pay the principal amount. So the company is not going to run out of liquidity. It is a benefit to the company. The third one, convertible debentures provide a safety net to investors. If the share price goes up, they can convert and attain growth. If the share price goes down, they continue receiving interest on debentures and also receive the principal at maturity. So that is another benefit to the investors. They have 2 options which they don't get with non-convertible debentures. So they have the option to convert. It is not a must for them to convert. So what will determine whether investors will convert them into shares? Mostly, it is the share price. If the share price is very attractive, then the investors will gain by converting the debentures into shares. But if the share prices are very low, then the investors will lose if they convert debentures into shares. So the best option in that case would be to keep them as debentures. So those are just a few benefits of convertible debentures. There are two sides of a convertible debenture. The first one is the debt side. If the investor does not want to convert the debentures into shares, the value of debentures can be calculated in a similar way to any other bond. So one of the options that the investors have is to keep the debt, because conversion is optional, not a must. So we can therefore find the value of a convertible debenture the same way we find the value of the other non-convertible debentures. So this is the equation we use. Value of a debenture is equal to present value of all interest plus present value of the principal at maturity. That is one side of the debenture, which is the debt side. So we also have the other side of convertible debentures, that is the equity side. If the investor converts the debenture into shares, its value is equal to the number of shares you would get multiplied by the market price per share. So this is the equity side, that is when investors convert the debentures into shares. So how do we find the value of the debenture? It will be given by the number of shares given after conversion multiplied by price per share. So those are the two sides of a debenture. So we are going to be looking at them in details later. First, let us see some of the terms used in convertible debentures. We are going to look at three terms: conversion ratio, conversion value, and conversion premium. So let us start with the first one, conversion ratio. So what is conversion ratio? This is the number of shares an investor will receive if they convert one debenture into shares. So here is an example. If one debenture can be changed into 50 shares, then we say the conversion ratio is 50. That is, one debenture is equal to 50 shares. So that is the first term. The second term is conversion value. So what is conversion value? This is the value of the debenture if it were converted into shares today. So how do we find conversion value? Conversion value is given by the current share price multiplied by conversion ratio. If you are converting today, you are going to use the current share price. Let's say you will be converting after 5 years, then you will use the expected share price after 5 years. So conversion value, therefore, should be the share price as at the time when conversion takes place, multiplied by the conversion ratio. The third term is conversion premium. So what is conversion premium? This is the extra amount investors pay for a convertible debenture above its conversion value because they like the flexibility of converting in the future. If you are buying a debenture today, most likely you are going to pay a higher price than the conversion value. So if you pay something that is higher than the conversion value, the excess you pay, we call it the conversion premium. There are two ways of calculating conversion premium. Conversion premium is equal to the market price of convertible debenture. That one should be provided in the question. It is the current selling price of one debenture. If the debentures are being traded in the market, in the capital market, then you take the price that the debentures are being sold at in the current stock market. Deduct the conversion value, which we have seen above. We have seen the formula of conversion value, the share price at the time of conversion times the conversion ratio. So whatever you get is the conversion value. So conversion premium is the market price of convertible debenture, deduct the conversion value. That will be the absolute premium in shillings. But you can also calculate the percentage premium. So conversion premium as a percentage is given by, you just take the conversion premium, the one that you had before, then you divide it by the conversion value. So conversion premium as a percentage is given by the market price of convertible debenture minus conversion value, all divided by conversion value and then multiplied by 100. So those are the three terms you're supposed to be aware of. You're supposed to know them when you are finding the value of debentures. So next, we want to apply those three in a question. So we have a simple example here. In this example, you are given the market price of convertible debenture is 1100 Kenya shillings. The conversion ratio is 50 shares. So this means that one debenture can be converted into 50 shares. The current share price is 20 shillings. So we want to calculate conversion value, conversion premium, the absolute amount, and the premium as a percentage. So you just need to recall the formula. So the formula for conversion value, we have said, is given by the current share price multiplied by conversion ratio. In other words, conversion value is showing us the value of shares if the debentures were to be converted at the current time. What would be the value of the shares the investor would get? So you take the current share price in the question, it is 20. You multiply by conversion ratio. In the question, it is 50. So 20 multiplied by 50 is 1000. So that means the debentures can be converted into shares worth 1000. Conversion premium. The first thing, remember the formula for conversion premium. We have said it is the market price of convertible debenture. You deduct the conversion value. Market price of convertible debenture is given in the question, and that is 1100. Conversion value is what we have just calculated, that is 1000. So 1100 minus 1000 will give us 100. So 100 is the conversion premium, and this is an absolute value in shillings. Next, we want to convert the premium into a percentage. So percentage premium is given by the market price of convertible debenture minus conversion value, all divided by conversion value. Or in other words, just take the premium that you have calculated 100 and divide it by the conversion value, which we have already calculated 1000. So 100 divided by 1000, and then because we want it to be a percentage, multiply by 100. So the percentage premium is going to be 10%. So that is how you can apply it in a question. So next, let us focus on valuation of convertible debenture. So when valuing a convertible debenture, we look at two things. The first thing we look at is the straight value, or the debt value. So this is what the convertible debenture is worth as a normal bond. And how much is it worth? That is interest plus principal. We are going to see that one later. Present value of interest plus present value of principal at maturity gives us the value of the debenture. Remember, we have said that convertible debentures have two sides. This one, the straight value, is the debt side, is the debt value. And for you to find it, you just take interest for all the years. You find the present value of the interest. You add to the present value of the principal once it matures. So calculate that one. And then calculate the value of the equity or conversion value. So equity value is the same as conversion value. And we have already seen the formula for conversion value in the previous example. So the equity value is what the convertible debenture is worth if converted into shares today. So you are supposed to calculate the two. The debenture value as a debt, the equity value if the debenture is to be converted today. Compare the two. If you are the investor, how would you decide whether to convert into equity or to keep the debt? So remember that investors want to maximize wealth. So they always select the higher of the two. If conversion into equity will give you a higher value, then you're going to select that one. You're going to convert into shares. But if conversion gives you less, then you will not convert. Instead, you are going to remain with the debt. So therefore, at no time is an investor going to select a lower value. Because the investors always select the higher value, we say that the theoretical value of a convertible debenture is the higher of the debt value and the equity value. That means you are going to calculate the value of each. Whichever is higher is the one you are going to select as the value of the convertible debenture. But there is something else you are going to add, which we have already seen. Remember, we have said this is the theoretical value. But in reality, the market price of a convertible debenture is usually a little higher than the higher of the two base values. If the straight value is higher, then in reality, the market price might be a little bit higher. Why? Because investors are not just buying debt or shares today, they are also buying an opportunity for the future. This opportunity is like an option. You are given something that others are not given. Therefore, you pay extra for the option to convert debentures into shares. If the share price rises in the future, investors can convert and gain. If the share price falls, they can hold as debt and still continue earning interest. So this is called a safety net. The safety net is you have the safety of debt, because if the share prices fall, you can remain with your debt. But if the share prices increase, there is the upside. You have the option to grow your wealth. So this safety net plus upside combination is very attractive, and investors are willing to pay extra for it. That extra is what we call the conversion premium. We have already defined what is conversion premium. So here we are just explaining it in a wider way. Which means once you have compared the debt value and the equity value, and you have selected the higher, you are still going to add something extra, which is called the premium. Therefore, in conclusion, what is the market price of a convertible debenture? The last sentence is answering that question. The market price of a convertible debenture is given by maximum. Compare the debt value and the conversion value. Select the maximum. Do not take both. If debt value is higher, you select it. If conversion value is higher, you select it. So you pick just one. Then after you have picked it, add premium, which is the price you pay for flexibility, for the option to convert. So in conclusion, the market price of a convertible debenture is given by the maximum of debt value or conversion value plus the premium you pay. And how do we find the premium? In the last slide, I have shown you the formula for finding the premium. In short, it is the current market price of a convertible debenture minus the conversion value. So that premium is what you are going to add to what you have selected. So to understand it better, let us look at an example. So in this example, you are given the face value of a convertible debenture is 1,000. You are also given the current price of a convertible debenture is 1,100, which means if you want to buy the debenture now, you will not be paying 1,000. Instead, you will be paying 1,100 because that is the price at which debentures are currently trading. But if you are to hold the debenture until maturity, you are going to be paid the face value 1,000. So the face value can also be called the par value. It can also be called the principal value. And then interest, also known as coupon, is given as 8% per year. Maturity is 5 years. The conversion ratio, you are told the debentures are convertible into 50 shares. The current share price is 20 shillings. Required return on similar non-convertible debt is 10%. So the required return is the one we normally use to find the present value. And the coupon rate is the one we use to calculate interest the investors earn from the debentures. So we are required to find the value of this debenture. And we are going to follow the steps we have seen previously. We want to calculate the debt value, and then we find the equity value. We compare the two, we pick the highest, and then whichever we have picked, we are going to add a premium. So in step 1, let us start by finding the debt value, also known as the straight bond value. So this is the value if you ignore conversion and treat it like a normal bond. It is very easy to calculate this one. You just find the present value of interest, and then you find the present value of the principal, and then you add them together. So what is the interest per year? Annual interest is 8%. 8% is the interest or the coupon rate multiplied by the face value 1,000. So remember, you're not supposed to use the current price to find the interest. Always use the face value to find the interest. So 8% of 1,000 is 80 shillings. And this one is going to be earned for 5 years. Each year, the investor will be receiving an interest of 80 for 5 years. So what is the present value of 80 for 5 years at an interest rate of 10%? Something that you receive every year, an income that you receive every year is called annuity. So if you use the annuity table, you are going to look for the fifth period and 10%. You can do this using a formula and a calculator, or you can just check the annuity tables. So the amount you receive every year, you are going to multiply it with the present value interest factor of annuity. So this figure here, you can read it from the table. It is going to be 3.791 in 3 decimal points. So 80 multiplied by that will give you 303 in whole number. So that is the present value of the interest. Next, we need to have present value of the principal. So remember, principal, you don't receive it every year. You receive it at maturity. In this case, maturity is 5 years. So you are going to receive it after 5 years during redemption. Therefore, it is not an annuity. It will only be received once. So present value of principal, we have said principal is the same as the face value, 1000. So the present value is 1000. You divide by 1.1 power 5. So this one is the discounting factor. Remember, we are using 10% as the discounting rate. So if you are using the table, this time you are not going to use the annuity table. You are going to use the one that does not have an A at the end, the present value interest factor. You check for 5 years and 10%. You multiply by 1000. Alternatively, you can do it without the use of tables. You take 1000, you divide by 1.1 power 5. So that will give you 621. So the debt value is the present value of interest, 303, plus the present value of principal, 621. So the total will give you 924. So 924 is the debt value. Now that you have the debt value, let us calculate the next one, which is the conversion value. In step 2, we want to see the conversion value. So recall the formula for conversion value. Conversion value is given by the current share price multiplied by conversion ratio. Because conversion is being done at the current time, we are using the current share price. So what is the current share price? In the question, we are given 20 shillings. So what is the conversion ratio? In the question, we are given 50 shares. One debenture can be converted into 50 shares. So the conversion value is 50 multiplied by 20, which gives us 1000. So this is the conversion value or the equity value. Compare the debt value and the conversion value. The debt value is 924. The conversion value is 1000. We said you are supposed to select the higher because investors will always select the higher. So 1000 is higher. So the value of the convertible debenture first is 1000, but we still have to add the premium. So in step 4, that is what we are going to do. We are going to add the premium to what we have selected above, to 1000. So recall the formula for calculating the premium. Premium is given by market price of convertible debenture minus conversion value. So we already have the conversion value is 1000. We have calculated it in step 2. Now look for the market price of convertible debenture. It should be given in the question. So in the question you are given current price of convertible debenture is equal to 1100. So premium is that market price 1100 minus conversion value 1000. That will give you 100. So the market price of a convertible debenture is equal to the maximum between debt value and conversion value. The maximum was 1000. To that maximum we add the premium, which is 100. So 1000 plus 100 gives us 1100. And that is the market price of a convertible debenture. In other words, that is the value of the convertible debenture. So this illustration is very simplified. In exam cases, there are some complications that can come. For example, you may not be given the current price of a convertible debenture. You may just be given the face value. If that is the case, you may not be able to find the premium. If you cannot be able to find the premium, then your answer is going to be the one you have selected between debt value and conversion value. Another twist in an exam is the conversion may be taking place in the future, not at the current time. So you may not have to use the current share price, but instead you use the price as at the time when conversion is taking place. So let us look at that one further. So here we have some aspects that we need to understand, further consideration. One is that debentures are usually converted at a future time and not the current time. What does that mean? It means that a future share price is often used instead of the current share price. If you are using the future share price, there is something else you have to do to it. If conversion takes place in the future, the present value of the shares must be determined. So remember what we do with the valuation of debentures. We normally calculate the present value of the principal because the principal is to be paid after a number of years. The same thing is going to apply here. If conversion takes place in the future, you have to estimate the share price in future and then you discount it. You find the present value of that share price. So the value of a convertible debenture is therefore determined as follows. 1. Present value of coupons plus present value of redemption. So this is just a repetition of what we have said before. Take the present value of interest, add the present value of the principal. Principal is the same as redemption value. That is the value of debt. But the value of equity in this case is the one that is going to change if you convert in the future. So you're going to compare that one with present value of coupon plus present value of conversion value. So you will notice here that the equity value, we are adding the coupon. So why are we adding the coupon? Initially we were just taking the conversion value, but here we have calculated the present value of conversion value, and in addition we have added the present value of coupon. The reason is, look at the NB below here. Before the conversion time comes, the investors will continue earning interest on the debentures. Therefore, the value of the convertible bond must consider the interest earned before the conversion time. If conversion takes place after 5 years, between the first year and the 5th year, the investor is earning all that interest. Regardless of whether you will convert or not, you are still earning all that interest. That is the reason why we are adding here present value of coupon to the conversion value. As long as you are not converting at the present time, you must always calculate the present value of conversion value. So just like we did before, you are going to compare these two. Number one is the debt value. Number two is the equity value. You are going to compare those two and take the higher as the value of the convertible debentures. So next, let us do another example where conversion takes place at a future time. So we have an example here. In this example, you are given the face value of a convertible debenture is 1,000. The coupon rate is 5%. The market interest rate is 6%. So this is something you are supposed to understand. When it comes to discounting, you may not be given directly, this is the discounting rate. If you are not given directly the discounting rate, we normally use the market interest rate as the discounting rate. And then the coupon rate is the one we use to find interest that the investors will be paid. So time to maturity is 5 years. Conversion ratio 25 shares, which means one convertible debenture can be converted into 25 shares. The current share price is 35 shillings. So using the above information, determine 1. Value of the redeemable bond. 2. Value of the convertible bond if conversion is done immediately. 3. Value of the convertible bond if conversion is done after 5 years. So let us start with number 1. Value of the redeemable bond. In other words, here we eliminate the option to convert. We assume that the debenture will be redeemed after 5 years. As we have seen previously, we are supposed to take the present value of interest and then you add it to the present value of the principal. That will be the value of the redeemable bond. So this is the solution for number 1. So the value of the redeemable bond is equal to present value of interest plus present value of principal at maturity. So we start by the first one, present value of interest. Interest per year is equal to the coupon rate. The coupon rate is 5% times the face value. The face value is 1,000. So 5% of 1,000 is 50 shillings per year. The investors will get 50 shillings per year for 5 years. So therefore the present value of interest is 50 multiplied by present value interest factor of annuity. Because if you receive this money every year, it is an annuity. So you're going to use the annuity table where you are given the number of period is 5 and the rate, the discounting rate is 6%, which is the market interest rate. If you use the table, you are going to get this value 4.212. So multiply it by 50, it will give you 210.6. So that is the present value of interest. So next, find the present value of principal. The principal is 1,000, but the principal is not an annuity. It will only be paid in the year of redemption, that is the 5th year. So you are going to use the table which is not the annuity table, the present value interest factor table, where the period is given as 5 and the discounting rate is 6%. So if you look at that table, you will get 0.747 and then you multiply it by 1000, it will give you 747. So this is the present value of the principal. So the value of redeemable bond is equal to present value of interest, which we have found as 210.6, plus present value of principal, which we have found as 747. So the total becomes 957.6. So that is the answer for required number 1, value of redeemable bond. We go to the second required. So number 2, we are supposed to calculate value of the convertible bond if conversion is done immediately. So note that if conversion is done immediately, so we have that point here, NB. If conversion is done immediately, the investor will not gain any interest on the bonds because time has not passed. Also, no need to find present value of the shares because you are converting at the current time. We don't find the present value of the shares, and we don't add any interest on the bond. So the conversion value will be the same as the formula I had given you earlier. We said the conversion value is the share price, the price per share at the time of conversion, multiplied by the conversion ratio. So the conversion ratio was 25 shares for one debenture. The current share price is 35. So 25 times 35 gives you 875. So that is the conversion value, assuming the convertible bonds are converted immediately. Now let us go to the third one. Value of the convertible bond if conversion is done after 5 years. So after 5 years, there are two things you are going to do. One is that the investors must be given the interest before the 5 years or up to the 5 years or up to the 5th year. And then the conversion value, this conversion value is as at the current time. But if the conversion value is after 5 years, then you will have to discount it to find its present value. So we are supposed to use the share price as at the time of conversion. But when you look at the question, you are only given one share price of 35. We don't know what the price will be after 5 years. In such a case, you are allowed to assume, you are allowed to use your assumption that the share price is going to remain the same. So because we are not given the share price after 5 years, we are going to use the one that we have of 35. So this is the value of the convertible bond if conversion is done after 5 years. So these are a few things you are supposed to note, and I have mentioned some of them. Use the share price at the time of conversion, which is after 5 years. If not given, assume the price remains constant. Consider the time value of money, meaning find the present value of the shares. As long as conversion takes place in the future, you have to do that. Before conversion time, the investor will continue earning interest on debentures. So this is a reminder of the given data, what we are given in the question. The time to maturity 5 years, conversion ratio 25 shares, current share price 35. So the future price is not provided, we are going to use the same price, which is the current price. So remember the formula that I had given you earlier. Value of a convertible bond where conversion takes place in the future is given by present value of coupon plus present value of conversion value. So each one must be at present value. Present value of coupon, we don't have to calculate it again because it is the same as what we had in required number 1. It was 210.6. So the only working we need is for the last part, present value of conversion value. So conversion value, the formula is you take the share price, you multiply by the conversion ratio, that 5 times 25, it will give us 875. But because 875 is after 5 years, we have to find the present value of 875. So multiply by the present value interest factor. Because this one is not an annuity, it will happen in the 5th year. So you check the table for the value, the discounting value for 5 years at 6%, which is 0.747. You multiply that by 875, it will give you 653.85. Then, according to the formula, you add the present value of coupon, 875. You add that one to the present value of conversion value, 653.85. So the value of the convertible bond, after you have added the two, will be 864.4. So that is how you calculate value of the convertible bond if conversion takes place at a future time. So let us continue with another example, because the more examples you do, the clearer it becomes. So we have example 2 here, which was taken from one of the past papers. It says, Beta Limited issued a 16% corporate bond with a par value of 1,000. The bond will either be redeemed at 20% premium after 5 years or converted into equity at a conversion rate of 100 shillings per 2 ordinary shares. Each ordinary share is currently trading at the Securities Exchange for 50 shillings. It is expected that the share price will increase at a constant rate of 5% each year. The minimum required rate of return by investors is 12%. If you are given the minimum required rate of return, you are supposed to use it as the discounting factor, as the discounting rate. Required. Number 1, the current value of the redeemable bond. 2, the current value of the convertible bond. So this one is straightforward. They're not asking you for the value of the bond. Instead, they are asking you for 2 things, the debt value and the equity value. Just that. So in required number 1, value of the redeemable bond, you are simply going to find value of the debt. The second one, value of the convertible bond, you are simply going to find value of the equity, the conversion value. So one thing you are going to note is that premium can only be calculated when the current market price of the debenture is given. If you can recall the formula for the premium, we had the market price of convertible debenture. And in most cases, you will find that most questions don't give you the current market price. For example, in our illustration here, you are only given the par value, which is 1,000, and you're not given any other price of the debenture. So it simply means you cannot be able to find the premium. So unless you are given the current market price, then just forget about calculation of the premium. So now let us start with the first one. This is very easy because it is the present value of the interest plus present value of the principal. So the current value of the redeemable bond. In the question we are given the coupon rate is 16%. The par value is 1,000. So what is the interest per year? 16% of 1,000, which is 160. So 160 is an annuity because you get it every year. So you are going to find the present value of 160. But before that, what is the redemption value? Remember, we were told that they would be redeemed at a 20% premium. 20% premium means they will be redeemed at a higher value than the face value. If the face value or the par value is 1,000, they will be redeemed at a price of 1,000 plus 20% of 1,000. 20% of 1,000 is 200. 200 plus 1,000 is 1,200. So after 5 years, the investors will be paid 1,200 instead of the face value of 1,000. Therefore, the present value of the redemption value, the principal in this case, is not going to be 1,000, it's going to be 1,200. What will actually be paid to investors after 5 years? So what is the conversion rate? So the conversion rate was given in the question. You were told the conversion will be 100 shillings per 2 shares. And one debenture is valued at 1,000. So if 100 gives you 2 shares, how many shares will you be given for 1,000? So 100 is equal to 2. So what about 1,000? So you can just cross multiply. And the answer you will find is 20. It means that one bond will be given 20 shares or will be converted into 20 shares. That is the conversion rate or the conversion ratio. So let us start with the first one. Value of the redeemable bonds. It should be given by present value of interest plus present value of the redemption value. So we have seen the interest is 160 per year. So the discounting factor, we have said interest is an annuity. So you are just going to check for the annuity factor in the tables. Check for 5 years at a rate of 12%. You'll get 3.6048 multiplied by 160 will give you 576.76. That is the present value of the interest. So next, find the present value of the redemption value. So this one is not an annuity. So you're going to check the table for the discounting factor. And this is not the annuity table. So once you check the table, 5 years, 12%, you will get 0.5674. Multiply that by the redemption value. So this time the redemption value is what the investors will be paid. And it is not the same as the face value. The face value was 1,000, but you were told that they will be paid 20% higher. So they will be paid 1,200. So the present value of the redemption value is 680.912. Current value of the redeemable bond is, you take the present value of interest, you add it to the present value of the redemption value 680.912. So after you have done the additions, the answer will be 1257.66. So that is the answer for the first part. Let us go to the next part. Current value of the convertible bond. So if you may recall the formula for this one, if conversion takes place in the future, take the present value of the interest, add the present value of the conversion value, and that is the answer. So first, we were given in the question, the current share price was 50. And then you are told that growth in share price is 5% per annum. So we can be able to find the share price after 5 years using this formula. Price after 5 years is equal to the current price of 50 multiplied by, because each year the rate of growth is constant, so in brackets it is going to be 1 plus the growth rate, 1 plus the growth rate, so it is 1.05 in brackets power the number of years, which is 5, power 5. This will give us the share price after 5 years, and it will give you 63.814. So as at the time of conversion, we are going to be using the price during the 5th year, which is 63.814. And then in the question, we also have the information. We also have this information. Investors' required return is 12%. We normally use the investors' required return as the discounting factor. Conversion rate, we have seen 1 bond is equals to 20 shares. So therefore the conversion value can be calculated as shown here. Take the conversion ratio, which we have seen is 20 shares. Multiply by the future price per share, or the price at the time of conversion, which we have seen is 63.814. So once you multiply the two, they will give you 1276.281. But this one is not the present value. So now we want to discount this one because it is taking place after 5 years. We want to bring it to the current price. So in the question, they specified it is the current value. So once they say it is the current value, it simply means we have to discount to get the present value. So present value of the share price or the conversion value, take your answer for the conversion value, multiply by the discounting factor, and this one is not an annuity. It is happening in the 5th year, not every year. So the discounting factor is 0.5674. You multiply by the conversion value. That will give you 724.196. So the conversion value, add this one to the present value of interest, which we had calculated before, and we found it to be 576.76. So add the present value of the interest to the present value of the conversion value. That will give you the current value of the convertible bond, which is 1300.96. So that is the answer for the second part of the question. And this is the end of the lesson. But one thing you are supposed to know is that we have not looked at the valuation of convertible preference shares. But if you know how to find the value of convertible debenture, you can follow the same pattern to find the value of a convertible preference share, because the formula is given here. It is given by the present value of dividends until conversion plus present value of conversion value. It is the same approach, the valuation of convertible preference shares. So use the same pattern as convertible debentures and you will get the answer. So that is the end of the lesson. Thank you for watching. See you in the next lesson.